Good morning, everyone, and welcome to our DATIQ Weekly Market Update. This is our update for December 5th, 2023. I'm Ken Animo, Chief of Analytics over here at DAT. I'm joined by Dean Croak, who's our Principal Industry Analyst, and our very special guest, Zach Rogers. Good morning, gentlemen.
Hey, good morning.
Hey, Ken. Thanks for having me.
You're where I was supposed to be this week, Zach. I was supposed to be out in the Denver area for our planning and our work Christmas party.
I know. I was waiting at the airport all morning. I couldn't see anywhere.
Our deer hunting plans got shifted, so that's where I'll be this week. I'll be running around the woods trying to grab a late season deer. So that's what happens when football season's over, guys. There's not much to do. College football season.
All right.
I don't know, man. The CSU Rams are 8-0 and ranked number 12 in basketball. So I have plenty going on over here.
Yeah, they've had some bigger publicity games. They didn't fare so well in them, but they were probably nationally covered more than typical this year, given all the hubbub in Boulder.
Oh, with football, sure, but basketball, man, we're undefeated. We're top 25. Things are good here.
That's awesome. I'm a huge college basketball nut too. I just tend to not get excited till after bowl season.
Well, sure.
I let the early season stuff play out where they're all finding their groove. Well, hey, do you mind introducing yourself to folks who might not be familiar?
Sure. My name is Zach Rogers, and as you could probably tell from what we were just talking about, I am a professor, associate professor of supply chain management at Colorado State University in Fort Collins, Colorado, as you can see from my cup this morning.
Nice. Well, thank you for joining us. Zach puts together the Logistics Managers Index, which we'll be talking about at length towards the second half of the program. But to get to that, I'm going to jump into the key points so we can bring Zach back for our discussion. All right, so let's get down to business here. So key trends we're watching: spot market line haul rates for dry van and reefer up as forecasted. It's very, very strong seasonal pressure. We'll be glossing through the forecast again this week because it's kind of an inverse ski slope there. Load post volume surge higher than in prior years. The November interstate carrier exits continue, but at a slower rate. We're probably, I didn't check this morning, we're hovering right around that 30,000 net attrits from the market in terms of interstate motor carrier authorities. So that's something to watch. And then the reason we have Zach on today, the Logistics Managers Index for November dips back in the contraction territory, which is pretty big news, and we'll let Zach talk about it here in a bit. But right now, I'm going to turn it over to Dean to walk us through the market update. Dean?
Yeah, thanks, Ken. Pretty consistent patterns across all equipment types this week. Volumes are up in the dry van market. Load post spiked last week. Again, seasonal trends kind of emerge in that catch-up week after Thanksgiving. Although last week volumes did almost triple compared to the normal doubling of volumes we see in the post-Thanksgiving week for week 48. Zach's going to talk a little bit more about this later and help explain why we're seeing a lot more volumes in the spot market this year. Load to truck ratio also up significantly to 3.64. In the refrigerated category, volumes almost double last week again, but it was the first 5-day shipping week after Thanksgiving. Carrier equipment post up also, load to truck ratio sitting at about 3.78. And in flatbed, the volume of load posts also doubled last week, still about 35% lower than this time last year, and about half the weekly volume reported in 2019 for flatbed. Load to truck ratio sitting at 7.73. Having a look at a couple of our markets this week around the country, we'll start off in dry van with our market condition index. Only one state last week didn't report a rate increase. That was Wyoming. Across the board, markets were up, in almost every large market. Los Angeles outbound rates up 5 cents a mile to $1.76. Significant. They've been flat for several weeks. Looking at some of the big warehouse markets out of Los Angeles, like Stockton, carriers averaged $2.59 last week. Phoenix loads, another big warehouse market, averaged $2.97. That's the highest in 12 months on the Los Angeles Phoenix lane. Having a look at the combined Joliet Chicago markets, big recipients of imports from Los Angeles, rates up 16 cents a mile last week, averaging $2.02. In the refrigerated category, I took a look at the meat patch last week: Arkansas, Iowa, Missouri, Nebraska, Oklahoma. Capacity was very tight last week, not surprising given the holiday season. Rates up 18 cents a mile in the Midwest to $2.43. Oklahoma and Kansas outbound reefer rates up 30 cents a mile, $1.97 and $2.55 respectively. Texas outbound reefer rates at $1.91, identical to where they were in 2018, up 5 cents a mile last week. And in flatbed, after dropping for the last 3 weeks, outbound spot rates in Houston, our largest spot market for flatbed carriers, up a penny per mile to an average of $1.90. Texas state average rates are just 6 cents a mile lower than where they were in 2018. One of the big lanes we watch is Houston to Lubbock in the Permian Basin oil field. Carriers average $2.18 a mile on that lane, even though production's high, rig counts are much lower. At $2.18 a mile, the lowest in 12 months. And also 60 cents a mile lower than where it was this time last year. Our second busiest lane out of Houston is Laredo. Loads moved were about 8% lower than this time last year. Spot rates at $1.69 are also the lowest in 12 months on that lane. And wrapping up with our year-over-year look at spot rates, dry van line haul rates up 10 cents a mile in the last 2 weeks. Last week, they were up 4 cents a mile. Remember, folks, these are excluding fuel. So these are line haul only. At $1.67 a mile, dry van line haul rates are 13 cents a mile lower than last year. And as you can see on the chart, compared to the green line, sitting about 5 cents a mile higher than in 2019. Our top 50 lanes, based on the volume of loads moved, averaged $1.97 last week, 30 cents a mile higher than the national average. In refrigerated, following a month of gains in the lead up to Thanksgiving, spot rates followed seasonal trends, dropping back a penny per mile last week to $1.99, sitting about 15 cents a mile lower than this time last year. And in flatbed, at $1.91 a mile, flatbed line haul rates are the highest in 2 months, following last week's 4 cent per mile increase. Rates are about 14 cents a mile lower than this time last year and sitting about 6 cents a mile higher than 2019. That's it for our market update this week. The long form version of today's report will be published this evening. Just go to dat.com/market update and download the report. Back to you, Ken, for the short-term forecast.
All right, so we're going to do some really deep analysis today, much like some of the folks on Twitter that are analyzing one freight bill that showed 47% margin on a load. These are the dry van short-term forecasts. The blue line is the actual data. There's 4 forecast models. What they are this week doesn't really matter. They all go up. That's the deep analysis. So this is the time of the year when rates go up. They don't go any other direction. Why do they go up? They go up because trucks by and large are going out of service, and there's a whole bunch more stuff to ship on a very condensed, very time-sensitive window. Last I checked, other than my wife, who's an after-Christmas bargain hunter, no one wants a Christmas tree on December 26th, a fake one at least, probably not a real one either. So there's a huge rush to get this stuff shipped. There will be a huge rush to get all the stuff that people didn't want for Christmas, namely the sweater. After Christmas, return back. So once the returns are done, rates will come back down. We'll probably have a very similar tongue-in-cheek description of the forecasts after Christmas, which show, and Hanukkah and all the other seasonal holidays, coming back down. So we'll start with dry van, up. We're going to go to reefer, up, even sharper. These are typically more perishable goods that really need to move. And then flatbed, up, but not as much, right? Unless you're getting coiled steel, which is what I have on my Christmas list, this flatbed forecast maybe isn't necessarily as prudent to you. And again, for flatbed, we've talked about this. This is more of a driver out of service and weather issue that drives rates up this time of year. I think tip your cap as you're driving down the highway. It's a much tougher job than driving dry van, right? Where they're out in a snowstorm or a sleet or all the inclement weather, checking their load, checking their straps and tie downs, which tends to drive the price up. Just human nature. You charge more money when you have to do all that extra work, and it frankly slows the freight down. You're stopping to check more often. So that's our forecasts. Let's get actually over to some meaningful analysis, because hot off the presses, we have the LMI print for the month, and we have the man who writes it to help explain. Dean?
Yeah, thanks, Ken. So, Zach, what's behind the big drop in the Logistics Managers Index for November?
Sure. So, if you just were to see the headline, LMI down to 49.4, you might think, wow, that's kind of the opposite of everything that Dean and Ken just told us. How did that happen? Because we were at a 56 last month, and that 56 was the highest we had since January, when we kind of had that echo after the holidays last year. And so, okay, 49.4, how did that happen? And it's interesting, I think, to compare this to the last time we had a 7-point drop, which was April of 2022. and as probably everybody on the call knows, April of 2022 was sort of the beginning of the dark times. That was when we went from having those high highs to freight recession, everything happened. That is not what this is. This 7-point drop is actually probably an indication that nature is healing itself. And let me explain what that means. The big driver this month was inventories. So inventory levels went from a 53 to a 44. So inventories contracted, and they really contracted upstream. They actually, downstream, they're about a 48, which is kind of holding steady. Upstream is a 40. And just, I should probably remind people, this is a change index. So any number 50 and above means expansion. And the higher above 50, this is greater the level of expansion. Below 50 is contraction. Further below 50, greater level of contraction. So to go to from a 53 to a 44, essentially what that means is we're moving back towards JIT. We had a lot of sales, obviously, in the second half of the month, and we break our numbers out by first and second half of the month, and you can see things were really moving in the second half of November in the way, Ken, to your point, that you would expect at this time of the year. Cyber Monday spending was up. Black Friday spending was up quite a bit. Not the big jumps that we've had in the past years, but it's still the biggest cyber week we've ever had. Just happened. And so things are moving. And I really think the difference between upstream and downstream, where upstream inventory levels are at 40, downstream's at 48.8. 48.8 is very close to 50. It essentially means no change. But we're kind of going down a little bit. And so that is exactly what JIT inventory management looks like, is 48, 49, 50, somewhere in there. And we saw a lot of reports from big retailers in the last couple months saying, yeah, we've drilled down, we're using AI now, all these things, we're really dialing our inventories in, coming after last year when inventories were out of control. The other thing that's interesting about this is inventory costs remained high. And so usually inventory levels and inventory costs move together, which I think makes sense. If we have a lot of inventory, costs go up. If we don't have a lot, costs go down. Well, inventories contracted at, like we said, at 44. Inventory costs came in at 62.3. That's a fairly notable delta between those two. And whenever we've seen that happen in the past, what that means is we're paying a lot for inventory because we have inventory coming, but it's as soon as it's hitting the shelves, it's moving. And so it seems like we're having inventories flow through the system really quickly. And, another, I think, data point in favor of that is warehousing prices are still in the mid to high 60s. If we really were just having a big contraction and there was no inventory, and there's some folks who online, Ken, you're talking about freight discussions on Twitter. I think we probably follow some of the same people. There's some corners that you can find online that think it's still doom and gloom out there, and based on what we're seeing, it's not. If it was really doom and gloom and the economy was dead, those warehousing prices would be falling too, because the low inventories would just mean, well, we didn't buy anything. Christmas is canceled this year. We'll try again next year. That's not what we're seeing. Things are moving, but because we've been so lean this year in terms of the way we built up, because we've been cautious after 2022 was kind of an inventory apocalypse. Those inventories are going down, and that is what has driven the overall LMI to that 49.4, which is a very mild level of contraction, but still is contraction.
Right. Zach,
how much sorry, go ahead, Dean.
I was just going to say, for our listeners, can you sort of describe what a warehouse might look like that's upstream versus downstream?
Yes. Yeah, that's a great question. So upstream is going to be more of your classic distribution center, B2B, pallets, driving scale. Downstream warehousing, where costs are certainly higher right now, are sort of like fulfillment centers. So think about the Amazon that's shipping you 1.8 lines per order versus the big distribution center that's sending out whole pallets of stuff to the grocery store or whatever.
Got it.
And so when we're talking about downstream, really what we're talking about is retail. Any of our respondents that are consumer facing, And we see a big difference with those, especially you would expect at this time of the year when we're so retail heavy in the economy.
Like, how do interest rates driving up the cost of carrying inventory play into the index, if at all?
So certainly we've seen inventories being cut since interest rates were high. And you know what's funny, Ken, is that supply was the biggest driver of inflation last year. And we had way too much inventory. I mean, if you look at our warehousing costs last year, everything was in the 80s, 70s. And because we had so much inventory, you know, we just said, oh, inventory levels down to, 44. This time last year, they were in the 60s, 70s. I mean, we had 80s. We hit 80 one time in February of 2022. That was right when all the ships that, were waiting outside LA unloaded. And so, all of that inventory just jammed up warehouses. And one of the things that we do is we make a composite metric that we call aggregate logistics price. So aggregate logistics price is combine inventory costs, warehousing prices, transportation prices. So these are three metrics that are all individually on a scale of 0 to 100. So we just add them all together. So now it's a scale of 0 to 300, okay? Where anything over 150 is growth. Last year, during the height of inflation, let me throw some numbers at you for March, April, and May. 270, 247, 241. Those were our aggregate logistics costs, if you put all three of those together. That's like the equivalent of numbers up in the 90s. And those months, by the way, April, May, June, that's when inflation was really out of control. And if you look at the breakout the San Francisco Fed does, Adam Shapiro, an analyst over there, does a breakout every month looking at how much of inflation is from supply inflation versus demand inflation. It was all supply. And so we've really seen that dovetail out. And if you compare it to where we are this month, we're at 170 for aggregate logistics costs. So we're a full 100 points lower than we were a year and a half ago. And we've been hovering around there. We even got down in the 150s this summer during the real peak of freight costs being nowhere. And so that has had a really strong deflationary push generally on the overall economy. And so it's funny, Ken, because it's circular. So the interest rates do certainly affect how much inventory you want to hold, but also how much inventory we were holding at the beginning of 2022 is the thing that drove inflation so high in the first place, which also caused the inflation rates. And so, yeah, interest rates make you want to pull inventories down, but it's actually inventories being driven down naturally that are the thing that's going to calm the Fed down and hopefully next year maybe think about, cooling it on the interest rates a little bit.
On the couple of the indices in the LMI, Zach, you've got transportation utilization and transportation capacity. Your report says that utilization is no longer increasing and capacity is expanding. It kind of supports what we've been seeing when we look at carrier authorities, both for large and large contract carriers and spot market carriers, both declining. Can you maybe dig into those two indices a little bit more to help our broker, carrier, freight-related listeners understand?
Absolutely. So transportation capacity has been expanding since last March. March of 2022 was the last time we saw a negative value there. And, we've been building fleets up, and there's a lot of reasons for that. And really the big thing is, we built up all these giant fleets to handle November 2021, volumes, and we haven't had November 2021 volumes in a while.
Right.
And so that's been moving. Now, what's funny is until this month, we had been trending steadily down. I think we peaked in June of this year. We had a 71. And probably most people on the call notes that was really the freight recession was tough this summer. And it had been trending down. We had a 56 last month, which was the lowest we have. Now we're up to 61. But really what that shows us is we are adding capacity, but I think now capacity is being added in a smart, targeted way. Right. It's not the out of control numbers that we had earlier this year or certainly last year. Right. It's sort of, okay, capacity is coming in. It's coming in where we need it. If you look at the split between upstream and downstream, what's funny is even though for everything else downstream, higher levels of utilization, higher levels of price growth, downstream price was actually a 50 this month, and it was positive last month. So we are seeing some price increases downstream, but capacity is also growing at a faster rate. It's a 65 to upstream's 59 this month. And really what that shows us, I think, is that, again, we're being smart. Okay, where do we need this extra capacity coming on? And a lot of it is leaning towards last mile delivery, or maybe the final mile between, distribution center and a retail store. That's where we see capacity growing right now. If we take it over utilization, our utilization dropped quite a bit from 67 last month down to a 52 this month. But again, split that out. Upstream utilization was 48. Downstream was about 56. And so downstream are the ones who are using the available transportation right now, which it's funny because usually you don't see utilization and capacity go up at the same time. But that's what we saw downstream. The other place I think it's helpful to break that out is if you look at sort of early versus late. Our capacity growth in the first half of November, so November 1st to the 17th is where we cut it, was 68 for transportation. So we had a lot of capacity that was sort of loose in the first half of the month. And in the second half of the month, we were down to 59. So we had about an 8-point drop in the second half of the month, just because things were getting busy again. And if we split that again, second half of the month downstream, you would see even more. So essentially we do have utilization. And what's funny about that utilization metric is if you look to this summer, it was in the 40s, May, June, and July. Like we really had negative, movements in utilization, and kind of what the real change point you can see is when yellow drops out, like mid-July, suddenly the first half July, second half July, suddenly utilization is going up again. And we had been saying, look, the freight market's not gonna, or the freight recession is not gonna end until supply and demand go back into balance. And usually what we would see is all the little carriers around the margins drop out early in the freight recession. That didn't happen this time for a number of reasons. Cash buildups, the sort of little ecosystems small carriers have with small shippers. But yellow dropping out in July is sort of pushing us back towards equilibrium. And now it's coming from both sides where we see demand coming up as well. And when we look at our future predictions, all of our respondents are expecting a fairly robust freight market in 2024.
Zach, dig a little bit deeper into your comment about smart capacity, because it kind of answers a big question we had from DATCon, where, for example, in November, we lost about 10,500, carrier authorities, but we gained almost 8,000. And one of the things we've been saying is that there's been probably an acceleration of capacity out of the long haul freight sector where you're subject to rate volatility and higher diesel costs, but a shift back in capacity at a lower level to other parts of the economy. I think that fits with your idea that the capacity is moving back to where it's needed. So would you agree that there's been a shift away from maybe long haul freight, but back to more regional dedicated type operations?
Yeah, absolutely. That is what's happening. It seems like, and really what's happening is we're moving back in some ways towards a pre-pandemic setup in some ways in terms of where freight is. Although it's certainly colored by the pandemic because it's less path dependent, right? It's not, oh, well, everything has to come out of the Inland Empire and then go somewhere else. We're not doing that anymore. There's no warehouses left in the Inland Empire to do that with. So, things are coming out of Phoenix or Atlanta or somewhere like that. Right. Although the East Coast is really been having a tough time, I think, with this Panama Canal situation, where you are seeing, I don't think those ports aren't going to be nearly as busy for the next few months because, 18 sailings a day in February through the canal. I mean, it's pretty bleak down there. But to your larger point, Dean, yeah, I agree with you. People are being smart. We kind of had the last, 2021 was just throw money everywhere you can. It's falling out of the sky anyway. So and it was basically cheap because we had low interest rates. And so just build everything. Okay, then we have this pullback. But it's clear, what's been so interesting to me is that even though we've had this pullback, people didn't stop ordering Class 8 trucks. We had this huge amounts of money built up over the last couple of years. And if order goes down, everyone knows the truck market's cyclical. It was a good time probably to place an order for a truck in the last 12 months, right? The market's down, but we know it's coming back. And what we're doing now is we're getting things that are smart. I think it's so telling that that Amazon, is shipping more parcels than UPS these days, and look at the way Amazon's sort of fleet looks versus UPS. Amazon really has a 21st century fleet in terms of where they're located, the size of the trucks, what they do, et cetera, et cetera. And so when I say we're being smart about it, that's one of the ways I think that we're being smart is let's put the capacity not only where it's needed right now, but where we think it's going to be needed. And clearly it's a bet on fulfillment.
Right. So Zach, we pretty much ask everyone that comes on, given where we are in the cycle, when do you see meaningful recovery into the next freight cycle?
So, every month we ask our respondents, where do you see this going in the next 12 months? And basically the way that we call freight recessions versus expansions is when we have an inversion between transportation capacity and transportation price. Okay, so whenever transportation capacity is higher than transportation price, we think that's a recession. And we've had maybe 4 or 5 inversions in the 7 years we've been doing this. One happened, kind of when the trade war kicked off. We had 2 right at the beginning of COVID where we flipped back and forth really quickly. One in sort of that summer of 2020 when things opened up again. And then one in, I think, May of 2022 when we moved back towards recession. And so since May of 2022, capacity has been growing at a faster rate than price. Well, if you look at our future predictions, our respondents are expecting capacity for transportation to be at a 48 over the next 12 months and prices to be at a 64. Okay. So that would represent a flip. I would say for me, if we're going to really get to those dynamics where we have prices 15 points higher than capacity, that's got to happen sometime, maybe Q2 of 24. I think is a decent time that we hear folks targeting. Could be Q3 when we ramp up for back to school and everything. But I think Q2 probably makes some sense. Now this could change. China could invade Taiwan or something, and then everything goes crazy. We didn't see Russia coming. We didn't see COVID coming. But in years where we haven't had a big black swan event like that, our respondents have been pretty accurate in terms of things flipping back and forth. And I would say, as a sort of addendum to that, okay, capacity was a 61 this month. Prices were a 44. So they're 17 points apart. By comparison, in May of this year, capacity was at 70 and prices were at 27. So back in May, that was like a 35, 40 point difference. Now it's down to a 16 point difference. And so the lines, right, capacity, price, they're trending towards each other. When that inversion will happen, I don't know, but I would guess probably if I had to say a number, Q2 of 2024, could be earlier, could be later, but it certainly seems like that inversion is coming, and then the cycle can begin anew.
I like this prediction because it exactly aligns with mine, and that's pretty much what I like the most. No, that's what we think too. And we've been tempering folks. I think sometimes snippets can be taken out of context, the sense that it's going to be like it was in November of 2021. In Q2 is not true, right? It took a long time to build that, right?
Right. And we don't necessarily want it to be like it was in November because that was an unsustainable level of growth. Like we were talking about earlier, that led to the crazy inflation that pushed us a lot into this downturn. November of 2021, it's kind of like driving 100 miles an hour. You can do it, but you shouldn't do it all the time. I think actually what we're seeing now, 60s, that is a good sustainable level of growth for transportation prices. We don't want to be in the 80s. We certainly don't want to be in the 30s anymore, but we don't want to be in the 80s, I don't think either. Maybe if you're a broker, it's great. But for everybody else, we need to have a balanced ecosystem. And the future predictions we have are balanced.
You know, what's really interesting is you have it's a high turnover industry, right? Even within shippers, it's do I have like a little thumbs up over my shoulder?
Yeah,
That was
weird.
Cool. Apple. Even in shippers, right? I mean, you could be procuring toilet paper one day, electricity the next, and transportation the next, right? I mean, there's a high turnover industry. So you have this crop of folks who were entered the industry and have only known it since COVID. And to them, this is like, you know, this kind of coming full circle to how we opened, right? To them, this is like, this whole profession might go away. We might have to manufacture everything in our homes and grow all of our vegetables, right? Nothing will move by truck ever again. And then you have the people that came in during ELDs, and they're like, well, every freight cycle is going to be crazy. It's just how crazy, right?
Yeah.
And then, you know, I don't go back nearly as far as, you know, Dean's seen far more cycles than me, but I've got about a decade of them, you know, and most of them are driven by supply, you know, trucks exiting the market to a point where spot rates start to elevate. It starts to drive up the price. It drives up to a sufficient level where everyone's excited to get back in the market. Then they add too many, and then they start to attrit. And that's the normal ebb and flow of the market that I think a lot of folks haven't been exposed to,
right?
Because they've only lived the past two cycles.
Yeah, you know, I have students that went to work for freight forwarders in 21 and 22, and in 21 they're like, "This is the greatest job of all time." You know, money just falls out of the sky, and you know, starting the end of last year, they all started calling me about getting into a purchasing job. And so it's you're absolutely right. The thing that I think has made this cycle so funny for them is that 2020. We blasted off into COVID. You know, a lot of people forget we're in a freight recession before COVID happened, right? 2019 was not a good year. And then suddenly, in the span of 2 months, e-commerce as a percentage of total retail went from 10% to about 17%, which is the equivalent of the growth that had done for the 6 years before. So the need for e-commerce, and think about the trucks and warehouse you need for that, we jumped forward 6 years in 2 months. Okay. And so we sort of blasted into this expansion. And then we came around to, you know, we were, I think, starting to have a natural slowdown at the end of 2021. But then remember, we had a terrible holiday season because remember Omicron, that like the last sequel of COVID.
And polar vortex.
That December. And then Russia invades Ukraine. Inflation goes insane because suddenly, you know, 1/10 of all the oil gets taken off the board for the whole world. 12th maybe. And so it was like we were a black swan going in and a black swan going out. And so we didn't have the normal slow transitions that you would see. And so I think that's what makes it so difficult for people who haven't been through a lot of these, is they're used to just one day something happens and things take off or slow down. And this freight recovery has really been a story of slowly moving back to equilibrium. There hasn't been a black swan event driving us back into a growth session. And that's, I think, why in some ways it's felt like this freight recession has gone on for so long, because the last ones you just flipped a switch and they either started or stopped.
Right.
Yeah, I can remember I exited the industry proper. So I was moving freight up until December of 2019. And that's as slow as I ever really remember it getting. And I didn't even have to weather the February, March of that year before COVID. You know, COVID at that point, I was actually flying home from Denver, and it was like the living dead. I mean, I was like walking through the big hall in the Denver airport, and there's like no one around. I'm like, what happened? And then the whole world went crazy. But I mean, at that point, if you entered freight at the end of the 2018 boom, it felt like very, very slow, very similar to how it does now. So,
right.
I think it'll be interesting to see what this next cycle looks like. I think
it tends to, I think, as long as there's not a big crazy thing, for every action there's an equal and opposite reaction. Now that was Isaac Newton, not me, but you know, I think we had this really hard correction to a hard move up. right? And now we're having a slow correction. And so I think that we'll have a reflection. The boom cycle, I think, tends to sort of be the echo of whatever the contraction cycle was. So you've had this kind of slow, steady cycle. And I wouldn't be surprised if we had that now going the other way, assuming we don't have another global pandemic or anything like that.
Right.
Well, there's only one way to find out. We go through. I'm ready to get hurt again, Zach. I'm ready to get out there. I'm ready for the.
I think you frame that as you're ready to love again. Okay,
I'm ready to love again.
You opening that cup. That's right.
I've always loved Freight. Well, ever since I got into it, I didn't know I loved it until I got into it, but I've loved it since then.
All right, so how can folks? By the things you care about, Ken.
Wow, we're getting deep today with my father-in-law actually bought this. I guess this is a knockoff of a designer sweater, which he thought he was going to get like a real version of the Ralph Lauren designer sweater, and it's like the ink is peeling off into my skin, so I need to get this thing off. How can folks get a hold of you, Zach?
So you can send me a note, zach.rogers, zac.rogers, at colostate.edu, COLO state.edu. You can also look for the LMI reports that come out the first Tuesday of every month, which is today. The November report just came out. And the last year of reports are up on our website. They're free for anybody to look at. Our website is the-lmi.com. And we're always happy to add more folks to our respondent list. This is really what we're trying to do is harness the wisdom of the crowd. We have a few hundred people, director level above, who respond to this. And basically what we found, and this probably won't be surprising to anybody, if you ask a lot of really smart people who are experts at what they do, what's happening, and then average all those together, you get a pretty good idea of what's going on. So any more smart people we can add, it just makes these numbers better, and we're always happy to talk to people about it, get you added to the mailing list or anything like that.
Awesome. Well, thank you for joining us. Dean, plugs?
Yeah, sales chatter tomorrow, 11 a.m. Eastern. It's Day-to-Day Wednesday. I'll be on with Dan Deegan. As always, we're on Sirius XM tomorrow night, channel 146 with Landline Now. Chris Kaplis, the latest Freight Vine podcast, has John Stauffer and Brian Crystal from Isometric Technologies talking about what on-time means in the freight market. And next week's show, we have Todd Amon from ATBS on the show talking about operating costs. And it'll be a great show because it'll help figure out where small fleets and owner-operators are by the end of the year. And with that, it's back to Ken to wrap up the show.
All right, I'd be remiss if I didn't at least call out Scott Miller's question. He's a loyal listener. He's asking about freight volumes, not just load post volumes. Honestly, I would forward you over to one of two sources, either Jason Miller up there at Michigan State, who has an index for total freight volumes, or I would forward you over to Tim Denoyer at ACT Research, who writes the CAS index. We don't do any holistic volume reporting here, just because the industry is so big and we don't see a representative enough sample, I don't think, to chime in on that. But our data feeds into the Michigan State one. And again, I think everyone's familiar with CAS. So those would be two great sources. And Jason Miller's like Batman. If you just call out, tag him on LinkedIn.
Yeah. Scott, if you need a number for anything, I'd go talk to Jason. He knows more about the government data right now than the government does.
Not surprised, but yeah. Former Buckeye, current Spartan. We'll live with that. I feel comfortable sending you over to him. But okay, so hopefully that answers your question. Sorry we went a little bit long today. This was an awesome discussion. We can't wait to have Zach back in a quarter or so, if he's willing to chat about this with us again. I hope everyone has a safe week with all the weather rolling in across the country, and we will see you next Tuesday at 10. Bye, everyone.
Bye.
Bye.